Today, we will talk about capitalized cost. A capitalized cost is an expense added to the cost basis of a fixed asset on a company's balance sheet. This means that the cost is not expensed in the period it was incurred, but recognized over a period of time via depreciation or amortization. Long-term assets, such as land, buildings, furniture, machinery, and software, will be depreciated or amortized over a long period to match the cost of the asset to the periods in which it is used and generating revenue. Capitalizing costs allows a company to follow the matching principle of accounting, which seeks to record expenses in the same period as the related revenues. For example, when a company constructs a warehouse, the costs associated with building the warehouse, including labor and financing costs, are added to the carrying value of the fixed asset on the balance sheet. These costs are then expensed through depreciation in future periods when revenues generated from the warehouse are recognized. In software development, only the costs from the application development stage should be capitalized. This includes salaries of employees working on the project, their bonuses, and data conversion costs. These costs are capitalized only if the project would need additional testing before application. For example, when a company builds a coffee roasting facility, costs such as customizing the facility, purchasing roasting and packing equipment, and installing equipment are capitalized. These capitalized costs are originally recorded on the balance sheet as an asset at their historical cost. They are then expensed through depreciation over the useful life of the asset. When high dollar value items are capitalized, expenses are smoothed out over multiple periods, allowing companies to show higher profits initially. However, inappropriately capitalizing costs can lead to misleading investors and potentially higher tax bills. This means companies should have a clear threshold for what they consider as an expense versus a capitalizable cost. Here are 4 key takeaways. 1. With capitalized costs, the monetary value isn't leaving the company with the purchase of an item, as it is retained in the form of a fixed or intangible asset. 2. The purpose of capitalizing costs is to better line up the cost of using an asset with the length of time in which the asset is generating revenue. 3. Companies each have a dollar value threshold for what it considers an expense versus a capitalizable cost. 4. Employee salaries and bonuses may be capitalized in certain situations. Hope this would help. Thanks for watching.